Welcome doers! It's fascinating to have you back, and I'm pumped to share with you today's key difference between passive and active investing. Let me ask you a question. Are you a long-term or short-term investor? Might anything exist in the middle? Which investment strategy should you use? What could be more profitable? Don't worry, I'm going to answer all these questions and even more. In fact, there is always a heated discussion on this topic. When I've studied and learned the investment strategies of ultra-rich people, I suddenly recognized my direction. That's when it hit me. It was clear for me in which of these two strategies I want to build wealth. So stick with me to the end of this video because you will find out my unique view and opinion. For now, let me explain how I see a major difference between passive and active investing, as well as something in the middle. Yes, you hear it right. There is a bridge between passive and active investing. That being said, let's kick off this video with a long-term investment strategy, which is passive investing. Look, you may have heard gazillion times term buy and hold. It's a type of philosophy or mentality, and it's fairly simple as it sounds. You buy a few asset classes here and there, and no matter what market does, you ride it because you assume it will grow over time. But my point is this: are you an emotional character, or are you emotional in nature? What I mean by that is when the market is up, your guts are full of butterflies. You feel like you are the best investor in the century, and you want to brag to everyone how well your performing portfolio is. On the flip side, when the market is down, are you panicking? Are you selling? Pause here a while and think about your character because it's part of this topic. And that's what I mean to be emotional. Listen, when the global pandemic hit the world this year, I talked to people about their assets because I'm usually curious about people's emotional reactions. Without any surprise, I found that some of them were really panicking and selling their assets. And what surprised me even deeper, they don't realize the market cycles. Certainly, the cycle might last a long time, but look, the market will recover anyway. And these folks were in their 30s and 40s, so enough time to rebalance, reallocate and recover the portfolio. But one thing's for sure, the absolute number one key is diversification. So how to diversify? The truth is, it's not as simple as it used to be. While I study ultra-rich people and their investment portfolios, I discover a pattern with basic 3 keys of asset allocation. Number 1, diversification across asset classes. Number 2, diversification across markets. And number 3, diversification across time. Yet, there is more to know. But for now, let's discuss these 3 asset allocations. Speaking of diversification number 1, a long-term investment portfolio has to include various types of asset classes. You may ask what they can be. First and foremost, it's about to know your risk tolerance and your time horizon. Then you decide whether to invest safely or aggressively if you are at your younger age, because you will have more time to recover. Now, conventional wisdom says, when you want to be conservative, you should choose actively managed mutual funds with intermediate or long-term fixed income bonds. Wrong. Why? Because these mutual funds have usually higher expense ratios with other fees that will gobble up your wallet every year. Instead, look at low-cost index funds or ETFs that have much lower fees. Next, you can explore low-risk assets such as structured notes or market-linked CDs. These are usually buried assets for everyday investors because they don't realize their existence. But it can be an absolutely worthy exploration because of achieving strong returns while betting on security. On the other hand, when you are willing to bet on growth and take more risk, your investment will fall usually within individual stocks, equity stock mutual funds, index funds, or ETFs. And like I said before, it's better to choose low-cost index funds or ETFs to decrease fees. And the second reason is you don't need to bet on an individual one stock company. Now, what about the real estate asset class? Real estate is a broad asset and you have many choices to pick from. But buying a whole piece of real estate might be expensive for some of you, or you might not want to manage it. Instead, you can choose publicly traded REIT, which stands for Real Estate Investment Trust, and collect quarterly dividends. Or even if you feel comfortable with crowdfunding real estate platforms. Now, when speaking of second diversification across markets, I'm talking about domestic, international, developed or emerging markets. Again, you can choose mutual funds, index funds or ETFs and allocate a certain percentage of your investment across these markets. And third diversification across time is the best approach by applying a dollar cost averaging strategy. It works like this. Let's say you set up bi-weekly or monthly an automated investment of $500 across your asset classes. Simple as it sounds, isn't it? So to summarize passive investing, let's have a look at benefits and drawbacks. An advantage is passive investing is a hands-off strategy. You don't need to be daily involved, but instead, maybe twice per year, review and rebalance your portfolio. The downside of passive investing, especially in mutual funds, is that it's not under your control because you let financial advisors manage your portfolio and you trust them, and they eat up a lot of your fees. The best advice is to find a dependable fiduciary that acts honestly on behalf of the client. Now, let's briefly discover something between. I call it passive to active investing. Passive to active investing usually applies to the private equity market as an angel investor or venture capital. And here is the fact. Let's imagine you invest in a startup through a syndicate or crowdfunding platform. This might sound like passive investing because it's a hands-off strategy and you won't usually see your money a few years. But if you are an experienced active angel investor, you might actively help the founders of the startup in a certain direction. Now, I don't mean to dictate how to run the company. What I mean to help in a certain area of your skills. It could be user acquisition, logistic resources, interior design, or just spreading the word of mouth. You get the point. You see, even your money is locked for a long period. It's not just passive investing, but you can be entirely active and you might get privilege at the table with key shareholders and investors. And lastly, let's talk about active investing. What is active investing, or who is an active investor? Sometimes you may come across the term activist investor. The simple truth is active investing is speculation. Do you remember what I said at the beginning about gut feeling and risk tolerance? And what I said about an emotional character? If not, rewind the video to the beginning, because with active investing it's much more intense. Why? Active investing requires a daily hands-on approach. It means that someone, either you or let's say the portfolio manager, tries to beat the time and market. But let's assume you possess strong technical trading analysis skills. Next to that, you are a super active doer and you might sometimes be successful in beating the market. And you might be pumped to gain your capital while sitting a few minutes behind the screen and trade currencies, forex or stocks. Well, if this resonates with you, good luck. Or another scenario. You might be in your 20s and you want to jump into the world of real estate and flip the houses. Well, you find an ugly deal but with brilliant numbers, and you close the deal, fix the property and sell it. My question is this something that you would like to explore? Again, if this is for you, good luck. To summarize active investing, let's have a look at benefits and drawbacks. Speaking of benefits, you can hedge your trading bets by using various techniques called put options or short selling. The other pros can be tax strategies, because you can sell assets on which you are losing money and offset with your big gains. The drawback of active investing is that it's riskier, stressful, emotional, and it can trigger mental uncontrolled disorder with addiction. And it might be expensive because of the fees, because all these fees can really kill your return. So finally, we've reached almost the end of this video. Good job, doers! Both passive and active investing is beneficial. My opinion is active investing is stressful, while passive might be more popular. So hands-on or hands-off investing strategy is totally up to you. I'm a long-term investor only. I never try to beat the market. Along with my elite SEO skills in digital marketing, I study in depth every day several types of asset classes and how they correlate with each other. Now it's your turn. What's your best performing asset class and why? Which market are you investing in? Are you trying to time and beat the market? Write in the comment investing, as I know you are a true and loyal fan of this channel, because I want you to take action and become a doer. Thanks for watching and I'll see you next week.